Syndication versus fund, which is better? Hey everyone, welcome to this week's video. Today we're going to talk about a bit of capital raising. Which is better, syndications or funds? Both are very commonly used methods for raising capitals to get deals done. There's pros and cons to each one, and to spoil the ending, there is no better one. There is a better one for each specific scenario, but overall, one is not better than the other. Now, if you're not familiar or don't know the exact distinction between syndications and funds, basically put, syndications are for individual properties. So you find a good property, you say, hey, I need to raise X amount of capital to purchase the property. You go out, you raise that capital based on that deal. A fund is where you pool capital together and you have an intention of purchasing specific properties, specific investments, and these investments get performed. They get aggregated, and the returns are aggregated returns distributed to the investors. So you have a difference there. One is deal by deal. The other is a pooling of capital to buy multiple properties. So let's go through a bit about the pros and cons of each. Firstly, I'll say that typically investors will graduate from syndication and then go and do funds. You don't see the reverse happening where someone's doing a fund and then goes to syndication. Also, it doesn't necessarily mean that a fund is higher level, although even typically it does mean higher level. I've seen some very successful operators stay in the syndication world, and even though they could graduate to a fund, they choose not to. And we'll go through a couple of those reasons why they might not do that. But let's dive into it. So we have syndications and we have funds. Syndication, as we said, is deal focused. So when you're going out and you're making a pitch, you're focusing on the deal itself. Now, don't get me wrong, the operator does matter. Limited partners typically want to see some good experience, whether you're doing a fund or a syndication. But a syndication is great because you can sell the deal. If you're an inexperienced investor and maybe you haven't done that many deals, if you go out and you find a great deal that's discounted below market, has some value add upside, that can overcome your inexperience as an operator. Now, of course, it's up to the limited partners to judge for themselves whether it's worth going into this investment versus a more experienced operator. But if you present a really good deal to them, that could be enough to get them over the line. So it's deal specific. With a fund, it's operator specific. So a fund, you're kind of promising that you're going to go out and find great deals that fit this criteria, but you don't actually have deals to show. So more of the emphasis is going to be on the operator itself. Have they shown in the past that they can successfully run deals? Because they're going to be, the limited partners are going to be committing money in the hope that the operator is going to be able to go out, find these deals, and not just find them, but execute upon them. So the fund is going to be very operator focused. And then the syndication is going to be a lot more deal specific focus. So those are two major distinctions, especially when you go out marketing for capital. And again, both matter. The deals and the operator definitely matter, but in the fund, you don't have the opportunity to show specific deals you'll be investing in quite at the outset because you're still just pulling capital. On the syndication side, can be a one-time deal. So you may come across, you might be a multifamily operator and you come across a absolutely killer retail deal. And you might say, hey, I'm usually doing funds in multifamily. I'm working with several investors, but this really good deal came around in retail and I want to figure out a way that I can capitalize on it. So you might go out with this one deal and you might say, to investors, hey, I know this isn't in my typical wheelhouse, but this is so far below market, and here's how I'm offsetting the risks. So you can do it in a syndication, whereas a fund, you can't just pull a retail deal into a fund unless your criteria of the fund really specifies that you're allowed to do that. With a fund, you require a repeatable model. So you can't just cherry pick these one-off deals that seem good unless that was specified when you were raising capital. Typically, what you need in a fund is a repeatable model. So a repeatable model might be buying at market value add multifamily that have below market rents, raising those rents and then selling. That's a repeatable model. If you're finding needle in the haystack deals that you can't replicate, then that's not a repeatable model, and you can't really build a fund off of that. Otherwise, you're just going to raise all this capital and not have anywhere to allocate it to. So you require a repeatable model on the fund side. On the syndication side, you can do it deal by deal. So now we're starting to get into some of the risk elements. Syndication has time pressure, and that time pressure is caused by earnest money risk. Now, think about the timeline. You can talk to limited partners for sure before you have a deal in mind, but it's going to be surface level talk. It's really going to be trying to sell yourself as an operator. But until you have an actual deal to present, there's no capital that can be allocated. There cannot be anything signed. But once you do get a property under contract, you effectively have 60 days on average to close on this property. And in that time, you need to get commitments for the capital. And if you're not able to get, the commitments, say you get to day 59 and you need to raise $3 million and you only have two committed, you're not going to be able to close, and your earnest money is going to go, would have already long gone hard. So you're going to potentially lose that earnest money deposit. And if this is a $10 million deal, you're raising $4 million. It's you could have anywhere from 100K to a million bucks in earnest money on the line. So there is a real time pressure with syndicating deals, and a lot of people don't like this time pressure. And it is one of the drawbacks of syndication. If you're not confident in the capital, being able to commit to a specific deal, then you put some real dollars at risk. On the fund side, you have less raising pressure. So you might say, hey, I'm going to raise money over the next 6 months. We're going to be on the road. We're going to be meeting with investors, and we're going to start this fund in 6 months. And you go out and raise capital. If you fail at raising that capital for the fund, it's going to do so. It's not going to have no consequences. You're going to have some reputational damage. If you get, $10 million in commitments and you needed 15 to start the fund, then you're going to have to go back to those that committed the 10 and say, hey, sorry, I couldn't raise the rest of the fund. Here's your capital back. So there is definitely some downsides of not being able to raise, but you typically don't have the same earnest money and a specific deadline. You can always extend a little bit the fund raising capital side, but definitely a fund is a bit nicer. And I do see a lot of newer investors just wanting to jump straight to funds, and it's pretty tough to do, but this is one of the reasons why they don't like the pressure of having EM at risk. Whereas a fund, you can't lay back, but your downside is really capped. So that's one of the big distinctions why a lot of people want to jump to funds, but it's not necessarily a great reason. Syndications, we have deal envy, and I'm talking about the limited partners having deal envy. So you're not just going to do one deal typically, you're going to want to do multiple deals. Now, imagine you pitch some LPs, they commit capital to your project, and suddenly, you close on that property, and then suddenly another even better deal comes up. Now you go out and try and raise capital for that deal. Some investors in that first deal are going to say, hey, like I would have gone into the second deal if it wasn't if I didn't go into the first one, now I'm tapped out of capital, and they're not going to be happy. You're going to get these dynamics in any kind of syndication. You're never going to get multiple equal deals all at the perfect time. It's going to be sporadic, and you're going to need to be careful about managing these expectations. Same goes if you absolutely knock a deal out of the park and it's the first one and you have a lot of investors involved. The expectations are going to be set that high for future deals. So you're going to have some investors in some deals, others in others. They're going to talk to each other if they know each other, and they're going to trade notes. And there's definitely going to be some buyer's remorse in there, and that's really unavoidable when it comes to syndications. You are going to get that crossover between people wishing they went into one deal and not another, and there's really no way around that. With a fund, all the LPs get the same deals. So you're pooling capital and you're saying, hey, I'm going to go out and buy this type of deal. If all of them get knocked out of the park, then everyone's going to kind of get an aggregated average of those returns. More likely, it's going to have some underperforming properties, some overperforming properties. But either way, everyone gets in the deal the same. You don't have that same deal envy that you do with syndications. All right, this is the last one, and this is probably the most important one that is overlooked. Now, we've had some, I'd say, negatives the past few ones in syndications, but this is one that people often overlook, and that is the GP upside potential. So if you're a GP and you are deciding whether to do a syndication or a fund, a syndication will typically have greater upside potential on the carry. So that's the promote that GPs get at the end of a deal when it pays out. It could be a 20%, 30% promote depending on the structure. It's going to be greater overall in a syndication than a fund. And I'm saying all things are equal, so you have the same deals, the same structure split, same fees and everything. A syndication will come out better for the GP than will a fund. And why is this? Well, you got to think about the upside and downside of a GP. So let's just say, I'm going to get a little technical here. You have an 8% pref. So if you as a GP don't make any money in the carry until that 8% internal rate of return threshold is breached. After that, you get an 80-20 split. So that's a common split, 8% pref, 80-20. So with the GP, if you make 7.99% internal rate of return or a 1% internal rate of return on the project, you're making zero as a GP because you haven't breached that 8%. All that, any returns are going to go straight to the limited partners. So your downside is kind of zero. You're not, sorry, your upside is zero in those cases, but you are capped. You're not going negative unless money's owed in other places. But it's not the same on the upside. If you absolutely knock a deal out of the park and you get 40, 50% internal rate of return, which can definitely happen if you buy the deal right. You get lucky with some tailwinds and rents going up and area booming, compressed cap rates. You can definitely get those kinds of returns. You can really, really take advantage of those because your carry is going to be much, much larger. With funds, you get a curve flattening return. So you might have that same deal that gets absolutely knocked out of the park, but that's going to get dragged down by the average deal. And of course, the underperforming deals are going to bring that back down to earth. So it's going to be a lot more stable, the fund, and it's eventually going to average out. And you're not going to have the chance to have those 40, 50% internal rate of return. So the syndication on average, with all things being equal, will actually make more capital for the GP. And I've seen in both real estate and even private equity where very experienced operators are actually just sticking with the syndication model, doing it deal by deal, and they forego the other negatives that we talked about previously because they know if they absolutely knock a deal out of the park, the GP upside potential is potentially huge. So I would say that last point is a huge one to consider. And as you can see, depending on whether your experience level and the type of deals you're looking at, a syndication could be better, a fund could be better. They have their pros and cons, but this is why both exist in the marketplace. So that's all we have for today. Thanks for listening, and we'll see you next week.